The U.S. Federal Reserve recently announced that it would be cutting off shadow banks from the reverse repo market, and as a result, 3 new banks are on the chopping block. This is a significant event that could have far-reaching consequences for the banking industry and the economy as a whole. First, let's talk about what the reverse repo market is and why it matters. Simply put, it's a market where banks and other financial institutions lend money to the Federal Reserve in exchange for safe and secure government bonds. This market is crucial for ensuring liquidity in the financial system, as it provides a safe haven for cash that is not currently being used. However, in recent years, the reverse repo market has been used by shadow banks as a way to earn a higher yield on their excess cash. This has caused the market to grow to over $1 trillion in size, which has raised concerns among regulators. The Federal Reserve has been looking for ways to reduce the size of the market, and this recent announcement is one of their attempts to do so. So, what does this mean for the banking industry? Well, the 3 banks that are on the chopping block are JP Chase, Wells Fargo, and State Street Corporation. These are all major players in the banking industry, and their exclusion from the reverse repo market could have serious consequences. For one, it could cause a liquidity crunch in the banking system, which could make it harder for banks to lend money to businesses and individuals. This could have a ripple effect throughout the economy, as it could lead to lower levels of investment, slower economic growth, and higher unemployment. Secondly, this move could have a significant impact on the profitability of these banks. The reverse repo market has been a source of easy money for many banks, and losing access to it could hurt their bottom line. This could lead to lower dividends for shareholders and reduced bonuses for bank executives. Finally, this move by the Federal Reserve could lead to increased regulatory scrutiny of the banking industry. Regulators have been concerned about the size of the reverse repo market for some time, and this latest move could be seen as a signal that they are ready to take action to reduce systemic risk. In conclusion, the decision by the Federal Reserve to cut off shadow banks from the reverse repo market is an important development that could have significant consequences for the banking industry and the economy as a whole. The exclusion of JP Chase, Wells Fargo, and State Street Corporation from this market could cause a liquidity crunch, hurt profitability, and lead to increased regulatory scrutiny. It remains to be seen what the long-term effects of this decision will be, but it's clear that it's a development that the banking industry will be watching closely in the coming weeks and months. Stay tuned.